Toronto's MLS home price index just logged its 25th consecutive month of year-over-year declines. 1 in every 20 homes in Brampton is a power of sale listing. 2 alternative lenders collapsed in the same week, and a PropTech platform with over 10,000 retail investors just filed for insolvency. That's the spring market. If inventory doesn't draw down until late 2026, what does that mean for landlords who need to refinance at today's rates with yesterday's valuation? And if the spring market underperformed 2 years in a row, at what point does the pent-up demand narrative stop being a credible thesis? When bankruptcies fall but CCAA filings rise, stress isn't decreasing. It's moving into larger, more complex organization. It's moving up the food chain. Toronto's MLS home price index just logged its 25th consecutive month of year-over-year declines. 1 in every 20 homes in Brampton is a power of sale listing. 2 alternative lenders collapsed in the same week, and a PropTech platform with over 10,000 retail investors just filed for insolvency. That's the spring market. Welcome to Smart Real Estate. I'm Addy Saeed, licensed broker with Remax Gold Realty, partner at Westcliff Asset Management, and founder at Westcliff Living. 19 years in Ontario multifamily acquisition, development, and asset management, and today I'm flying solo, breaking down 9 stories that every Ontario apartment investor, broker, and mortgage professional needs to understand right now. This week, we have market data, insolvency signals, lender failures, a fractional investing platform collapse, landlord-tenant board reform updates, a major urban real estate repositioning story, and a generational infrastructure announcement that most people in this space haven't connected to real estate yet. When you read all of these stories together, not in isolation, a very clear picture emerges about where the market actually is. That's what we're doing today. But first, before we dive in, if you're not already on our platform, go to learninvestmanage.com and sign up. It's completely free, no credit card, no payment required. You'll get access to all of our underwriting tools, and we'll personally invite you to our school community where you can connect directly with other investors doing deals in Ontario right now. The link is in our show notes, learninvestmanage.com. Now let's get into it. We're starting with the market. And we're spending extra time here because the data that dropped this week from both TREB and RBC Economics deserves a little more than just a headline read. TREB released their April 2026 Market Watch on May 5th. RBC dropped their National Housing Analysis this very next day. Same data set, 2 different lenses. Together, they paint a picture that is more nuanced and more concerning than most of the coverage you've seen this week. GTA home sales in April, 5,946, up 7% year over year. On the surface, that sounds encouraging, but here's the thing. New listings dropped 9.3%. Active listings are down 6.4%. So sales are up not because demand surged, but because supply pulled back. That distinction matters enormously when you're trying to read market direction. Average selling price just over $1,051,000, down 4.9% year over year. The MLS benchmark composite is down 6.6%. RBC's Robert Hogue puts the Toronto HPI decline at 6.5% year over year. That's 25th consecutive month of annual price declines. Now add the financing context. Bank of Canada's overnight lending rate at 2.3%, prime 4.5%, but the 5-year fixed rate mortgage, the one that most buyers actually use, is sitting at 6.09%. That's higher than it was before the Middle East conflict escalated in February. It had been coming down. Now it's climbing back up. So you have a market where prices are falling, but the actual financing cost hasn't moved with them in the direction borrowers need. That's the affordability trap. The RBC reports make something very clear that the TREB headline numbers obscure. Toronto's April transactions are still 36% below the 10-year average. A 7% year-over-year increase sounds like momentum, but when you're 36% below the normal, that's not recovery. It's just less bad. So the condo numbers deserve specific attention. Condo apartments average 635,653, down 6.3% year over year. RBC breaks it down further. York Region condos are down 11.7%. Durham condos are down 11.6%. These are meaningful price reductions in markets where a lot of investors bought at peak leverage in 2021 and 2022. Days on market up 16%. Average property days on market are now 43 days versus 37 a year ago. Sellers are waiting longer. Buyers have more time, more choice, more leverage. That's a structural shift in negotiation dynamics, and it flows directly into how you underwrite an acquisition right now. The sales to new listing ratio, RBC's measure of supply and demand balance, which sits at 0.35 for Toronto. Balanced market is roughly 0.4 to 0.6. We're meaningfully below that threshold, firmly in buyer's territory. Now let's look at what's sitting behind it all. Toronto unemployment numbers 0.1% as of March 2026. Toronto unemployment growth negative 0.3% year over year. Real GDP contracted 0.6% in Q4 2025. Inflation 2.4%. Falling employment, contracting GDP, elevated mortgage rates, 25-year consecutive price declines. RBC's Robert Hogue is direct about this. Buyer confidence is missing. Trade war uncertainty, geopolitical pressure, job market weakness, the spring season has not delivered the demand boost everyone was hoping for. And RBC's forward call, the downtrend persists until inventory is drawn more meaningfully lower. They don't expect that until later in 2026. So we're likely looking at another 2 to 3 quarters of this environment. One more thing worth flagging, the picture isn't uniform across Canada. Calgary, Edmonton, parts of Prairies, Quebec, Atlantic Canada, those markets are holding better. Price appreciation is still happening in some of those markets. Vancouver is deeply in buyer market territory with prices down 6.9%, the fastest rate since the rate shock in spring 2023. For Ontario-focused investors, you're operating in a buyer's market with falling prices, tight financing, rising unemployment, and a lender community that is scrutinizing every deal that crosses their desk. Underwrite with that reality front and center. 3 things to take away from this market data. Number 1, GTA sale activity improved in April but remains 36 lower for the 10-year average. This is not recovery, it's stabilization at a depressed level. Number 2, condo values are under the most pressure. York and Durham regions down over 11%. If you're underwriting with condo comparables, your numbers need to reflect today's reality. Number 3, financing conditions remain tight. The 5-year fixed is at 6.09% despite Bank of Canada cuts. Until that moves materially, demand will stay muted. 2 questions worth sitting with. If inventory doesn't draw down until late 2026, what does that mean for landlords who need to refinance at today's rates with yesterday's valuation? And if the spring market underperformed 2 years in a row, at what point does the pent-up demand narrative stop being a credible thesis? That macro picture sets up everything else we're covering today because the stress in the market isn't abstract. It's showing up in specific postal codes, in specific balance sheets. Let's go to Brampton. The Globe and Mail ran a piece on May 1st about mortgage delinquencies in Brampton. Reporter Rochelle, working with Equifax Canada data. This is not anecdotal. These are hard numbers from the country's largest credit bureau. Brampton's mortgage delinquency rate, defined as 90 or more days of missed payments, hit 0.6% in Q4 2025. The national rate is 0.26%. Brampton is running at more than double the national average. But here's what makes it more alarming than the current number. The trajectory. In 2019, Brampton's delinquency rate was 0.06%. Now it's 0.6%. That's a tenfold increase in 10 years. Equifax has named 5 cities as their primary drivers of Canada's overall delinquency surge: Brampton, Toronto, Markham, Oshawa, and Vancouver. That's our market. The 905 and the 416 carrying the disproportionate share of the national delinquency load. The mortgage size data is critical here. Homeowners with mortgages between $800,000 and $1 million have a delinquency rate of 1.13%. Compare that to 0.2% for loans under $300,000. The most exposed borrowers are the ones who bought at the peak prices with large mortgages and are now renewing at rates nearly double what they originally signed. The typical Brampton home price nearly doubled from $638,000 in 2019 to $1.24 million in 2022. It's since fallen down about 30% to roughly $855,000. Buyers who purchased near the peak are now underwater. They can't refinance and pull equity out. They're trapped. 2 compounding factors make Brampton uniquely exposed. Manufacturing accounts for 12% of Brampton's workforce versus 7% in Toronto. And tariff-driven disruption is hitting that sector hard right now. And Brampton has the highest percentage of multi-generational households in Canada, 14.3% versus 2.9% nationally. Those households have higher fixed costs and less margin when mortgage payments are reset. The power of sale numbers are striking. 1 in every 20 homes in Brampton is currently a power of sale listing. In the rest of the country, it's nearly 1 in every 50. 14 power of sale completions in Brampton in Q1 2026. Last year, 43 in Brampton versus 13 in Mississauga. In 2022, at the peak, there were only 5 foreclosed sales in Brampton. And looking forward, OSFI has confirmed that approximately 1.3 million Canadian mortgages, 22% of all mortgages, were originated in 2021 and 2022 and are still renewing at this time. OSFI expects those homeowners to face material monthly payment increases. This is not a 2026 problem. It runs into 2027 as well. 3 takeaways. 1. Brampton delinquency rate is at 0.6% versus 0.26% national average, the highest amongst major Canadian cities according to Equifax. Number 2, the most exposed borrowers have mortgages between $800,000 and $1 million and are renewing now and face payment increases they cannot absorb. And number 3, power of sale activity is at decades high and will continue as 1.3 million mortgages from 2021 and 2022 vintage continue to renew. Questions worth watching. If the Bank of Canada raises their rate later this year, what does that do for the renewal math for Brampton borrowers who haven't renewed yet? And at what price point do power of sale properties start representing genuine investor value at today's financing cost? The homeowner stress story connects directly to what's happening at the lender level. When borrowers stop paying, lenders feel it. And this week, 2 lenders felt it hard. 2 alternative lenders were placed into receivership in the same week. Brightpath Capital on April 10th, and Finova Financing on April 16th. Different sectors, same outcome. Brightpath Capital is an Ontario and BC mortgage originator. They paired direct lending with a scrutinized model. Here's the capital structure that blew up. 15.6 million owed to secured lender Pivot Financial. 59.6 million in principal plus $5 million in accrued interest owed to 141 unsecured note holders. And their core asset, a 9.7 million portfolio of 19 mortgage loans, is already power of sale proceeding. Assets worth $9.7 million. Liabilities worth over $80 million. That gap tells you how far the write-offs went before it unraveled. What triggered it? More than $15 million in write-offs. Covenant defaults triggered enforcement in October 2025. A CBCA restructuring was attempted and failed. Lender forbearance broke down and KCB was appointed a receiver. For the 141 unsecured note holder, this is a lesson about capital stack position. Unsecured is the riskiest position in a distressed lending structure. When the secured lender enforces and assets are worth a fraction of liabilities, unsecured recovery can be minimal or zero. Finova Financing is Quebec-based auto lending, not real estate directly, but relevant as a pattern signal. Placed into receivership by 9-point partners, owed approximately $22.4 million. Total liabilities, $31.7 million against a lease portfolio roughly valued at $10.9 million. Same story, liabilities drastically exceeding assets. Two alternative lenders collapsing in the same week is not a coincidence. It's a credit cycle signal. Non-bank lending expanded rapidly at the low-rate environment. Underwriting standards stretched. Now, with rates elevated, collateral values failing, and borrowers under stress, these decisions are surfacing as losses. If you're currently using an alternative lender for financing, know your lender's balance sheet health as well as you know the property you're financing. Understand their funding model. Understand their capital structure. If your lender goes into receivership while you're an active mortgage, the servicing gets transferred, but that transition isn't always as smooth. So takeaways. 1. Brightpath had over $80 million in liabilities against $9.7 million in mortgage assets, a cascade that a failed CBCA restructuring couldn't stop. 2. 141 unsecured note holders are exposed. Capital stack position determines recovery. And number 3, two alternative lenders failing in the same week signals a broader credit quality deterioration in a non-bank lending. So here's the question to ask. If alternative lending capacity contracts, where do borrowers who can't qualify for a lender level go? And how does that reshape deal velocity in Ontario over the next 12 to 14 months? From lender stress to PropTech stress, the company is called Addy Technology, not me. Different Addy. Completely different person, completely different company. Addy Technology Corp is a Vancouver-based fintech platform. I'm a broker in Mississauga. No relation whatsoever. Had to say it. Moving on. Addy Technology filed a notice of intention to make a proposal under the Bankruptcy and Insolvency Act on April 16, 2026. The platform allowed retail investors to participate in property-backed opportunities through a software-enabled marketplace. Over 10,600 investors, more than 60 property-backed issuances across more than 24 properties. 3 pressure points hit simultaneously. Securities law oversight tightened, compliance costs exploded. Real estate market weakness killed the value of the underlying asset and new investment activity, which killed revenue. And the company burned through the liquidity faster than it could cut costs. They raised $900,000 in preferred equity in May 2025, but early 2026, the money was gone. 9 months from a $900,000 raise to insolvency. That tells you how deep the revenue problem was. The restructuring structure matters for those 10,600 investors. The proposed transaction is a reverse vesting order with an Anthem Capital affiliate as the stalking horse buyer. In an RBO, the core assets, the proprietary software and the tax attributes, stay in the surviving entity. The excluded liabilities and non-core assets, including the SPV exposures, get transferred out into a residual entity headed for bankruptcy. Retail investors deployed capital through SPVs, special purpose vehicles. Those SPVs are in the excluded bucket headed for bankruptcy. Recovery is complicated and potentially very limited. The fractional investing model is structurally fragile in a down market. When you strip away the technology and the marketing, fractional real estate through SPVs is a compliance-heavy structure that requires sustained transaction volume and real estate appreciation to remain viable. When the market turns and compliance costs rise simultaneously, the model is extremely fragile. The technology platform is not the investment, the underlying real estate is. And when the real estate underperforms, the platform disappears first. Couple of takeaways. Number 1, Addy Technology failed due to simultaneous hits from compliance costs, failing real estate values, and collapsing transactional revenues. Number 2, 10,600 retail investors have exposures through SPV moving into a residual bankruptcy entity. Recovery is uncertain. And number 3, fractional investing model is structurally fragile in a down market. technology platforms don't protect against underlying asset deterioration. The Addy Technology story sits inside a broader insolvency trend that OSB data confirms this week. The Office of the Superintendent of Bankruptcy released February 2026 corporate filing data. There's also a Q1 2026 CCAA league table in circulation. Together, they tell us where corporate distress is sitting in Canada right now. So total corporate filings in February 2020 is 331 versus 365 in February 2025, down 9.3%. Total bankruptcies down 11.9%. On the surface, that looks like an improvement. But here's the number that matters. CCAA filing in February were 11, up from 8 a year ago, an increase of 37.5%. The distinction matters enormously. Bankruptcy means a company has no viable path forward, assets liquidated, creditors take what is available. CCAA, which stands for Companies Creditors Arrangement Act, which means the business is long enough and complex enough that it's attempting a structured restructuring. There's still value worth preserving. When bankruptcies fall but CCAA filings rise, stress isn't decreasing. It's moving into larger, more complex organization. It's moving up the food chain. The trailing 12-month picture, total filing down 16.6%. Bankruptcies are down 17.7%, but CCAA is flat, 70 versus 70. High frequency insolvencies declining, large, complex restructuring holding steady and trending up monthly. So Q1 2026 CCAA league table shows 20 total industry filing for the quarter. Grant Thornton and Raymond Shaba leading as monitors with 8 filings. This is active restructuring work at scale. So CCAA activity typically involves commercial landlords, construction companies, development entities, and companies with significant real estate related obligation. When large operators restructure, it creates lease termination, construction stoppages, and counterparty risk across the supply chain. That ripples through commercial real estate and the residential development pipeline. The Brightpath receivership, the Addy Technology NOI, and the rising CCAA trends are 3 data points pointing in the same direction. Capital is under stress, and the stress is complex, and it hasn't peaked yet. So a couple of takeaways. Number 1, CCAA filing jumped 37.5% year over year in February. Stress moving up the complexity ladder. Number 2, 20 CCAA filing in Q1 2026 alone. Real restructuring activity at scale. And number 3, when CCAA rises while bankruptcies fall, larger organizations are under stress. That has supply chain and real estate implication broader than most investors realize. Quick pause. If you're finding this useful, learninvestmanage.com is where we put all of our tools. Sign up free, use the underwriting calculator, and join the community. Link is in the show notes. So we've covered a lot of stress. Let's talk about something that's actually moving in the right direction and has operational implication for every landlord in Ontario. The Landlord and Tenant Board has been one of the single biggest operational risk in Ontario multifamily investors for 3 years. Cases sitting 8 to 10 months before a hearing, orders taking weeks. After that, a backlog that is at one point exceeded 53,000 cases. According to official Tribunal Ontario data, non-payment for rent applications, your L1s, are now being scheduled within approximately 3 months of filing, down from 8 to 10 months in 2023. That's real, meaningful improvement. Most other application types are running 5 to 7 months. Urgent matters like illegal lockout, 5 to 6 months. Orders are being issued within 30 days of hearing on average. Most other application types are running 5 to 7 months. Urgent matters like illegal lockouts, 5 to 6 weeks. Orders are being issued within 30 days of hearing on average. So, volume context. The LTB scheduled over 105,000 hearings in 2024 and resolved nearly 100,000 cases, the highest number in the board's history. So, Bill 60, the Fighting Delays and Building Faster Act, passed in Ontario Legislature on November 24, 2025. The legislation contained amendments to the Residential Tenancies Act specifically designed to further streamline the LTB. But as of March 2026, those amendments are not in force yet. Tribunal Ontario is still preparing for implementation. So the improvements you're seeing right now are strictly operational, process improvements, more adjudicators, more digital tools. The legislative improvements from Bill 60 are still coming. They haven't landed yet. And the backlog? While it's down from 53,000 to roughly 41,000, it still remains substantial. This is better. It's not fixed. If you have a non-payment issue today, you're looking at roughly 3 months to a hearing versus 8 to 12 months from 2 years ago. That's a material change to your cash flow risk calculation. When Bill 60 amendments do come into force, one key provision requires 50% of the rent arrears to be paid before a tenant can raise maintenance issues as a delay tactic. That removes one of the most common litigation strategies used to extend proceedings. Watch for the proclamation page. For anyone underwriting a value-add acquisition right now, the LTB timeline is part of your hold period model. The improved LTB doesn't eliminate tenancy risk, it just reduces it. So a couple of takeaways. Number 1, L1 hearings are now averaging 3 months versus 8 to 10 months in 2023. Confirmed improvement. Number 2, Bill 60 amendment passed, but not yet in force as of March 2026. The next significant improvement is still ahead. And number three, 40,000 plus cases, backlog remains. Better, but not resolved. Factor this into your operating underwriting. From operations to urban land use, some of the most strategically significant real estate moves in Canada happened quietly in the course this week. So, retail insider Craig Patterson reported on April 29th that purchase agreements have been signed for several of Canada's most prominent former Hudson Bay properties: Vancouver, Calgary, Ottawa, and Windsor. These are landmark sites and the buyers are not retailers. Context first. These properties were part of the RioCan Hudson Bay joint venture, which entered receivership after HBC filed for creditor protection in March 2025. FTI Consulting was appointed a receiver. CBRE ran a national marketing process. 32 parties signed confidentiality agreement for the Vancouver property alone. Strong demand for a well-located urban real estate when, even as the retail model collapsed underneath it. The buyers tell the story. Vancouver, Oni Group acquired the 674 Grenville Street flagship, one of the city's most active large-scale mixed-use developer. Calgary, Astra Real Estate, parent of People First Developments, acquiring the downtown site. People First has been active in office to residential conversions, directly addressing Calgary's elevated office vacancy. Ottawa, Claridge Homes, one of Capital's major high-density residential developers, acquiring the Rideau Street property. And Windsor, Primaris REIT, which already owns Devonshire Mall, buying the Hudson Bay anchor within its own mall. The Windsor transaction is structurally different from the others. Primaris isn't redeveloping. They're consolidating ownership of a key anchor within an asset they already control. Full flexibility to release, subdivide, and reposition without a third-party owner complicating the decision. The Ottawa deal is the most direct relevant for Ontario investors. Claridge Homes acquiring the Rideau site property signals residential intensification in the heart of downtown Ottawa. That property's scale and location gives it flexibility for high-density mixed-use, retail, residential, and potentially office. The departmental store model didn't just weaken, it ended. The real estate it occupied is now being repositioned for residential density, mixed use, and adaptive reuse. That's a structural shift, not cyclical. Carrying costs during the receivership exceeded $9.8 million. Closing timelines expected as early as May and June 2026. For Ontario multifamily investors, watch what happens to land value and zoning in the blocks adjacent to these properties. The secondary opportunity lives in those surrounding neighborhoods, not necessarily in the flagship site itself. Couple of takeaways. Purchase agreements signed across 4 major properties. All buyers are developers or landlords. The department store anchor model is over. Number 2, Ottawa's acquisition by Claridge signals high-density residential intensification in Canada's downtown core. And number 3, large format urban converting to residential is a structural shift. Watch adjacent land values and density approvals. We've been talking about stress and repositioning. Let's close on something forward-looking, because this week Ontario made a generational infrastructure decision that most real estate investors haven't connected to home demand yet, but they should. This morning, today, May 7, 2026, the Ontario government directed the IESO to enter into a cost-sharing agreement with Bruce Power to formally advance the Bruce C nuclear project, the first large-scale nuclear build in Canada in nearly 30 years. And the numbers attached to it are significant enough that every real estate investor in this province should understand them. Up to 4,800 megawatts of new generating capacity, enough to power 4.8 million homes. 300 million in pre-development work starting now and completing by 2030. Federal impact assessment started in 2024, expected completion in 2028. Then, a multi-year construction project. This project will be under active development for 15 to 20 years minimum. The economic numbers from Ontario Chamber of Commerce: 238 billion contribution to Canada's GDP. 18,900 jobs during construction annually, 6,700 permanent operational jobs. On a local basis, $2 billion contributed to local GDP annually, $427 million in labor income, 3,400 full-time jobs in Bruce County, Grey County, and Huron County communities. Here's what I think most investors miss. Large-scale infrastructure projects of this magnitude create housing demand that spans decades. Think about what happens in communities surrounding Bruce Power between now and 2030. Just on pre-development work. Engineers, environmental assessment terms, Indigenous engagement professionals, construction planners, supply chain coordinators, these people need housing. When full construction begins, the workforce demand grows drastically. Bruce County, Saugeen Shores, Kincardine, Goderich, Owen Sound, these are markets your typical GTA-focused investor has never looked at. But they're markets about to experience a multi-decade employment-driven housing demand, and they're currently priced nowhere near what that demand will ultimately support. The broader economic logic matters for Ontario beyond Bruce County. Ontario's electricity demand is projected to grow up to 90% by 2050. Energy security is what attracts advanced manufacturing, electric vehicles, battery production, green steel, data centers, AI infrastructure. These industries need workers. Workers need housing. The chain is long, but the logic is direct. Note that 95% of Bruce's power spending stays in Canada. The domestic supply chain is largely based in southern Ontario, the 905 Hamilton Barrie. The economic multiplier from this project travels well beyond the Bruce County. One important flag, this is pre-development work. 300 million in spending runs by 2030. Construction doesn't begin until after the federal impact assessment completes in 2028. This is a long horizon story. The time to be watching these secondary markets is now, not after the crane goes up. Couple of takeaways. Bruce C is a 4,800 megawatt, 238 billion GDP impact project creating 18,900 construction jobs and 6,700 permanent positions. Redevelopment runs to 2030. Construction to follow. Number 2, Bruce County, Grey County, and Huron County are entering multi-decade employment and housing demand cycle. Secondary market investors should be paying attention now. And number 3, Ontario's 90% electricity demand growth forecast drives industrial investment. Industrial investment drives employment. Employment drives housing demand. The chain is long. The logic is direct. Questions to watch. What's the current housing supply look like in Kincardine and Saugeen Shores? And what's the gap between current supply and projected workforce housing demand? And how should Ontario multifamily investors think about portfolio diversification beyond the GTA? 3 themes ran across everything we covered today. Theme 1, stress is layered and compounding. The market data, the Brampton delinquencies, the lender failures, the PropTech collapse, the CCAA activity, these aren't separate stories. They're the same story told in different vantage points. Credit stress in Ontario is real, multi-layered, and hasn't peaked yet. Theme number 2, relief is real, but incomplete. The LTB is genuinely improving. Some markets are showing tentative stabilization, but don't mistake improvement for resolution. And theme number 3, the long horizon opportunity is starting to become visible. The Bruce C announcement and the Hudson Bay urban repositioning, the secondary market infrastructure story, these are signals of where the next decade of real estate demand is building. The investors talking about this now will have significant advantage over those who wait for a consensus. So you have 3 takeaways. Number 1, from the market data, Toronto transactions are 36% below the 10-year average, with prices down for 25 consecutive months. The market is not recovering. It is stabilizing at a depressed level. Underwrite accordingly. Number 2, from the insolvency and delinquency data, credit stress is moving up the complexity ladder, from homeowners to alternative lenders to larger corporations. The feedback loops between these layers are tightening. And number 3, from the Bruce C Power announcement, generational infrastructure investment creates generational housing demand. Secondary markets in Ontario are going to matter more over the next 20 years than most GTA-focused investors currently appreciate. If you got value out of this episode, subscribe wherever you listen and go to learninvestmanners.com. Sign up for free. Get access to all of our tools. We'll send you an invite to our school community as well. No payment required. Just show up and start learning. The investors who win in this market aren't the ones with the most capital or the most confidence. They're the ones who understand what data is actually saying and have the discipline to act on it before the crowd catches up. Some required disclosures. Addy Saeed is a licensed real estate broker with Remax Gold Realty, founder and general manager of Westcliff Living, and an OSC registered dealing rep. Kaz Jaffer is a CPAC and an OSC dealing rep. Rivu Ramprasad is a licensed mortgage broker level 2 with BLD Financials, DLC license 12360. All 3 partners and co-founders of entities referenced in this episode. This podcast is for informational and educational purposes only. Nothing in this episode constitutes financial, legal, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decisions. Past performance is not indicative of future results. Smarties, I'll see you in the next episode. Take care.